I think I just want to get your reaction first and foremost to that bounce that we saw yesterday off that initial jobless claims report. Do you have confidence that this is just a kind of resumption of the momentum that we saw, or do you see more volatility ahead? I'm just looking right here, a number of reports coming up, PCE, Fed minutes, Jackson Hole. I mean, there's so much other data points that could be market movers ahead.
Precisely, and that's the big question mark, how they are going to come through, right? Of course, we've had a great data point yesterday, but we had bad data points beforehand, and the market reaction shows you how vulnerable it is to positive or negative news coming through, right? And I worry that this is going to continue. So back a few weeks ago in our global quarterly outlook titled Weathering Volatility, we've been pointing out many reasons why the market should be, why you should expect volatility ahead. And some of these worries that we've had have come down after the big market reaction and the correction that we've had, but some are still still ahead of us, and we need to see how they are playing out, right?
All right. You have a new report out. I want to get to it. We're going to show one part of this report. You have a graphic that you share with us. According to your report, the markets are pricing in more EPS growth than the consensus is right now, approximately 20% according to your proprietary data. That's the markets compared to the estimates of just about 15%. What does that say about sentiment? What does that possibly say about volatility going forward?
The caveat about this chart is it's the US market, not the global equity market, right? So this is our proprietary model that tries to capture what kind of EPS outlook is priced in by the market. So back a month ago, US market was pricing in double the EPS growth of what the analyst consensus has been expecting, right? So you could have argued it's too exuberant, too expensive. Now the market has come down 10%. We've had a meaningful correction. Now the US market is pricing in, yes, slightly above the analyst forecast, but the reporting season in the US has been pretty good, right? So you could say the market is more fairly priced. But what is interesting, markets outside of the US, like Japan or Europe, where I especially concentrate on, from pricing in above consensus analyst EPS growth, is now pricing below. So what that means is, if you're bearish on the global outlook, and let's not forget the US economy is slowing down, right? It's been slowing down for quite a few months right now. So if you're worried about this outlook and you think the analysts are too bullish, that means that there is a buffer that has opened up for Europe or for Japan, Japanese equities to absorb these downgrades. Now, if it turns out global growth is intact and everything is going to be okay, then of course these markets have moved down too much, pricing in too much of bad news.
That's a pretty crucial if right there. Just important to note, we were showing it a second ago. You are overweight on the U.S. market. If you don't mind, I want to bounce something off of you from a note that came out earlier this week from Strategist. I know you have your own research, but I just want to get your take on this. According to this note, it says going back to 1990, the average inter-year drawdown for the S&P is just about 15%. We're about halfway through the historical average, excluding the macro that's been associated with this sell-off. NVIDIA is set to report towards the later half of this month, which may be the final arbiter for the direction of the AI trade and the broader market. Of course, the AI trade's powered the market a lot this year. That NVIDIA report, is that also one of the next big inflections for this market in your mind?
Look, I think the market is going to start moving back to the mindset of looking at what the earnings outlook is going to be, what the economic data is going to be, where the momentum is going. And of course, the biggest part of the growth coming from the US market has been coming from the tech sector, right? So definitely all the big tech names reporting better or worse numbers than expected is very, very important. Now, to the point, to the quote you've made, of course, what it tells you is that corrections are a natural thing in the market. We have a 10% plus correction almost every single year, right, for the last 30 years. Now, we have this framework that is called bear market checklist, which tries to differentiate between just another correction you buy into or the correction you sell because it's the beginning of the next bear market. Right now, our bear market checklist is telling us buy into it. However, one thing that worries me, and that's to do with tech and NASDAQ, is that positioning after the sell-off has not come down completely, right? It's still at elevated levels in these growthy parts of the market, meaning it's vulnerable to bad news. That's all.